Hi, we will be doing a financial analysis of IBM in comparison with Oracle. Our aim here is to analyze which of the two companies would we invest in. Now, I'll just run you through an agenda. We will start with the industry and then move on to the key drivers and challenges. We will finally talk about the timeline, what are their two competitors in this industry, what is the street's analysis of IBM and Oracle, and what are the expectations? What are the biggest risks? What business segmentation do they fall into, and their business drivers? Also, we will move on to their executive compensation structure. Finally, the most important part of the whole presentation is the horizontal and the vertical analysis and some of the key ratios that help us decide as an investor or as a creditor what or how much will we invest in each of these companies or which companies would we invest in. Moving on, uh, before we begin, please note that because both these companies, IBM and Oracle, have a different financial year ending, we have assumed that both the companies have a year end on 31st of December of each year. Now, moving on to the next slide where we talk about IBM's portfolio. This is a chart which shows about IBM's products. IBM GTS over here, known as IBM Hardware, contributes to around 40% of IBM's business. GTS has grown from just servers and networking solutions to mobility and cloud services implementations. Next is IBM Software Group, which contributed to around 28% of IBM's business in 2008. The primary business in this space was the middleware solutions, which helped IBM catapult its market share. Solutions like IBM WebSphere and Lotus Notes was the leading solutions within the software group. IBM's WebSphere contributed to approximately around 70 to 75% of the non-open source market. And next we have is IBM Global Business Services, which pretty much dealt with software implementations with their initiatives like smarter offices, smarter cities, and other smarter planet initiatives. They contributed around 19% of IBM's business in December of 2014. Finally, we have IBM's STG or IBM's hardware business, which consistently dropped to 11% in December 2014 in spite of introduction of products like Pure Systems, which was an integrated solution for customers. IBM's financing arm of contributed a stagnant of 2%. Now, what were each of these companies' key drivers? IBM was moving on from its hardware business, and the most important key driver for IBM was its business in the cloud, analytics, mobile, and social and security business. If you hear in the earnings call where Martin Schroeder says, who is the CFO of the company, he says that this cloud, analytic, mobile, and solution generates approximately around 25 billion in revenue, which is 27%, which is grown by 16% year on year. The software cloud business, which is the new Bluemix or the cloud solution, is also another key driver. The Power 8 systems, which is their proprietary hardware business, is also another key driver in the hardware solutions. It also came out with innovations like Watson and healthcare businesses, which was a constant research and development that is still happening. Finally, with Oracle, Oracle had solutions around cloud and software as a service and platform as a service. They had an ever growing cloud business of 200%. They were also migrating their existing users and existing customers to cloud. And finally, they were also having a hardware business, which was the only company in the hardware world which was showing some kind of profit, according to their earnings call. Moving on to the next slide, we will talk about the timelines and the history of IBM and Oracle. IBM was established in 1911 and coming on to 2012, where IBM did a series of acquisitions. In 2014, like we were discussing previously, IBM sold off its part of its server business to Lenovo. Meanwhile, Oracle was established in 1977. Oracle acquired Sun Microsystems in 2010. It also partnered with its rivals like SAP and IBM for cloud enhancements for its cloud solutions, basically migrating their existing solutions into cloud. In 2014, Oracle decided, Larry Ellison decided to step down as a CEO and elected two co CEOs to lead the company. We move on to the next slide, which is a quite easier slide to understand. If we see over here, we see this just two bifurcations where Oracle's business is divided into software and cloud and hardware systems. The software business was contributing approximately around 84% of software and cloud business was contributing to approximately around 84% of their total revenue in 2014. These included softwares like Oracle Apps, Oracle ADF Mobile, Oracle App Server, and obviously their most popular solution, Oracle Database. Oracle hardware mainly consisted of their acquisition from Sun Microsystems. Let's move on to the key competitors. Now, IBM had four competitors in this space: IBM, Oracle, Microsoft, and SAP. These were the largest players in the software and the hardware business. IBM contributed to approximately around $92.79 billion in 2014. Oracle generated approximately around $38.23 billion. Microsoft, a huge competitor in this space, had $93.58 billion. And finally, SAP was $21.34 billion in revenue. Now let's move on to the next slide, which talks about the number of employees each of the organizations had and also what was the revenue per employee. If you see over here, the slides clearly show about how Oracle had a higher advantage in terms of revenue per employee. Oracle was generating approximately around $289,000 per employee, whereas IBM was approximately around $244,000 in spite of the higher revenue generated by IBM.
This is Wall Street position. So in this section, I'll present our findings on the financial market position and expectations relative to IBM and Oracle. Here is some general information on both companies. So both Oracle and IBM show growth in its first year sales as well as significant net income in the recent fiscal year, ended in December 2014 and May 2015 respectively. And both companies also present low risk according to their auditors, which is a good sign for investors to make decisions. So by looking deeper in the figures like revenue and operating income in the past 5 years, we came up with the numbers and growth rate for both companies. Well, first of all, for IBM, revenue growth for IBM software was relatively steady over the 5 years to 2015. And even though the traditional middleware revenue declined slightly over the 5 years, according to IBM's annual reports, their security, mobile, cloud, as well as the software as a service have all been significant growth areas for IBM. In 2015, industry relevant revenue is expected to fall a 6.5% to a 9.3 billion while maintaining a high profit margin. Well, for Oracle, the performance and operating income has been growing fast as we see from the financial performance chart and are expected to reach approximately 14.3 billion US dollars in 2016. The growth is significantly attributed to Oracle's massive acquisitions in the past 5 years. Other revenue sources include their licensing, product support, as well as their cloud services. So the next is for risks. Now we move to business analysis. This includes risks, market segmentations, including small and medium businesses and large enterprises, business drivers, and analysis on business operations based on each company's SEC filings and other public documentations. So generally speaking, both companies are identify similar risks to their business respectively. They share common risks such as uncertainty in economic and business conditions, which makes it hard to predict the growth for both companies. However, the general landscape of the industry indicate that they still have a substantial room for growth. For risks, we derived from IBM's 2014 10K report include the following. Failure of innovation initiatives that may impact the long-term success of the company, and risks from investing in growth opportunities that may impact the earnings and the business. And also, intellectual property may not prevent competitive offerings, and the companies may find it difficult in obtaining certain software licenses. Risks of Oracle include the items below, like overall demand for enterprise software, cloud offerings, hardware systems, and services. And also, cloud business in particular may adversely affect their profitability. We cannot ignore the government budget constraints and shifts in government spending priorities also play an important role. Here's a brief SWOT analysis of IBM. It has a strong business model. It has established a position in the middleware market, and its continuous innovation consists of the strength of IBM. However, the litigation could negatively impact brand image. Moreover, the intense competition across the segments as well as the exchange rate fluctuation consists of the threat. But there are opportunities, including the increased focus of big data and cloud services, as well as the strategic expansion of IBM's consulting business as it bought the PwC consulting, so we can expect what it can achieve on that. For SWOT analysis on Oracle, it has a diversified geographic presence and customer base, and also it has a strong margin and cash position. Yet it has been struggling with its traditional hardware system business, as well as bears a large debt obligations. The opportunity comes as the increased adoption of cloud computing services, as its stock went up after Larry Ellison announced its cloud service recently, the growing enterprise software spending, and we can expect large revenue earned on this segment, as well as big data presence growth opportunities.
So, taking a look at the horizontal analysis of IBM's financial documents, we first take a look at the balance sheet. Now, the balance sheet portrays the value of a company at any given point of time. So, looking at IBM's balance sheet for 2014, we realize that the company's value has decreased since 2013. Although there are a few entities like the intra company financing receivables and other receivables, as well as the total equity that have increased over the year, it wasn't enough to keep up the overall value of the company than last year. Now, on the other hand, Oracle seems to be doing pretty well, comparatively having increased the overall value of the company from the previous year. The balances show a few negatives with prepaid expenses which were probably consumed during the year and aren't large enough to affect the overall value. When we take a look at IBM's income statement as well, we can see that the total revenue and net income doesn't look too good when compared to 2013, and their earnings per share also stays low. While on the other hand, Oracle are still on track, increasing the net income and total revenue in 2014, and the EPS is still on the rise. Now, taking a look at the vertical analysis of the same financial sheets, we learn a little more about what companies gain and spend on each entry. Looking at IBM's balance sheet, we can see that most of their assets are client financing assets or loans. But then when we look at their income statement, we notice that this financing has the least contribution to their total revenue. That will make you wonder as to why even bother financing your clients. But then when we get back to the income statement, we see that their services and sales are the biggest source of their revenue for them. And so for them to attract customers, both small or large, helping them finance would definitely make them more likely to buy from them. And while looking at Oracle's vertical analysis, there's nothing out of the ordinary, which means just that their marketable securities are the majority of their assets, and their revenues coming from their license and softwares.
Return on equity. Return on equity is a measure of how profitable a company is. It's essentially a measure of how efficiently a company can make more money with the amount of money invested into it. We see here that IBM has a considerably higher return on equity than Oracle. This suggests to us that IBM may be more efficient at generating revenue. Earnings per share. Earnings per share can be interpreted as a general measure of how much profit each shareholder has made based on the company's performance. Because this metric is denominated by the number of shares outstanding, and because it is a very commonly examined metric, it's not uncommon for companies to try and influence this through buybacks of share. IBM, again, has significantly higher earnings per share than Oracle. We believe that IBM's significantly higher earnings per share was likely influenced by the $5 billion buyback program that the company launched in October of 2014. Return on assets is a measure of how efficiently a company can use its assets to generate income. IBM and Oracle's return on assets are relatively close. This signals to us that the operational efficiencies of both companies are also relatively similar. Current ratio is a measure of the liquidity of a company. Essentially, it's a metric to measure a firm's ability to pay for its liabilities with its assets. Oracle maintains a considerably higher current ratio than IBM. We interpret this as Oracle holding onto a larger amount of cash relative to the amount of debt that it has than IBM does. The debt-to-equity ratio, as its name suggests, relates the amount of debt to the amount of equity a company has. It can be interpreted as a measure of the quality of financing a firm has. Intuitively, when it is necessary to inject money into operations, it's better to do so with equity than to do so with debt. Dividends can be issued at the discretion of the company, but debt is legally binding and must be paid when it's due. Cash coverage ratio. Take 1. Cash coverage ratio. The cash coverage ratio is a measure of solvency. It relates the amount of cash a firm has on hand to the amount of interest expense that it has to pay. In one sense, this is very similar to the debt-to-equity ratio, in that the interest expense may also be interpreted as a proxy measure of the amount of debt that a firm has. The cash ratio is an indicator of how much cash an entity is able to quickly access in relation to the amount of liability an entity has, as we mentioned earlier. Similar to the current ratio, it relates the available assets to upcoming liabilities. We note that IBM has a considerably lower cash ratio than Oracle, at 0.21 to Oracle's 2.70. While this may appear somewhat alarming initially, we must also consider that IBM is a considerably larger company with a net worth almost thrice that of Oracle. A smaller cash ratio may still mean that IBM holds more readily available cash than Oracle. IBM also has a relatively low current ratio. This may be explained by IBM moving away from holding physical inventory due to its move towards cloud. Oracle, on the other hand, does still sell some hardware, and this may contribute towards its higher current ratio. A high current ratio is not necessarily desirable because it may indicate operating inefficiencies. In Oracle's case, it has a considerable cash reserve that it is not using. In considering whether we would like to be a creditor to either IBM or Oracle, we looked at several of their most recent key liquidity ratios. Amongst these were the cash ratio and current ratio. We also examined several solvency ratios, which included the cash coverage ratio and the debt-to-equity ratio. Overall, from a creditor's perspective, Oracle appears to be a more conservative and lower risk investment. IBM, while it is in a transitional stage after having just done a large restructuring of its business, appears to be a riskier investment that may potentially yield greater returns. In conclusion, we believe that in the short term, Oracle may be a more stable choice because its liquidity and solvency ratios indicate it's a less risky investment. IBM, on the other hand, may yield better long-term results because of the restructuring and investments it is making. Although IBM appears to have a higher return, our assessment suggests we should approach investing in it with caution. While it does have considerably higher return ratios, its return on equity and earnings per share may be inflated by the almost annual stock buybacks that IBM instates. This may hide any long-term concerns by catering to short-term performance metrics.